Okay, we're going to move on from the work we've been doing the last few weeks with variance analysis, and we're going to look at what happens in decentralized organizations. How do we evaluate performance, and how do we account for transactions within different parts of the same company? A definition of a decentralized organization is really all about who's got the authority to make decisions. In the cases that we'll look at here, the subunits have managers that are held accountable for either costs, profits, or return on investment. It's important for us to know that there's no model for a strict decentralized organization. It's usually just a matter of degree. Some of the advantages of decentralization, we can really isolate information and have better information to make decisions. Decentralized organizations put managers with accountability closer to their markets, closer to their customers, closer to their operations, and theoretically they can respond more quickly. There's also a motivational aspect to decentralization. We really get managers involved with what's happening within their unit. And by doing so, that in turn leads to training for increased responsibilities in the organization as a whole. On the other hand, there are some disadvantages that come with decentralized divisional activities. It's possible that we could have divisions duplicating different activities that might be better and more efficiently done from a central location. The other problem is we have managers of these different divisions that may not always be pursuing goals that are aligned with one another. We're going to take a look at a case example later this week that will help illustrate this. When companies are attempting to evaluate how well their subunits are performing, they're making that decision to understand where is value being created in the organization and which of those subunits can add more value by being expanded or which aren't creating value and perhaps need to be contracted or restructured. Along with that, the managers of those subunits are being provided with some motivations and incentives that hopefully will cause them to act in a way that maximizes the value of the entire firm. This particular area is one that we have to refer to one of the key principles of managerial accounting, and that is you get what you measure. The corollary for which is be careful what you measure, because it results in motivation for managers. And we've got to make sure that they're being motivated in the direction that maximizes the value of the firm. When we construct a decentralized organization, we really see there are three different types of responsibility centers. And they're almost layered one onto the other. First of all, we start with cost centers. These subunits are responsible for controlling costs, but not revenue. We have a lot of service departments. In fact, many of us either do or have worked at some time in our career for a service department. You can see here these are sort of corporate staff departments. The key here is that they have to provide this service at a reasonable cost, so we have to evaluate them based on how they are doing relative to budget or standard or relative to other benchmarks for performance. So cost centers, how are they doing against budgeted, expected, or benchmarked cost targets? Now, profit centers, we add the top line into their responsibility. They're still responsible for costs, just as the cost center was. But they're also responsible for generating the revenues that form the top line. And hence, top line revenues plus cost responsibility gives us overall responsibility of these units for bottom line profit. And of course, the goal is no longer to minimize costs. The goal is to maximize the profit. What this does is it motivates the managers to focus their attention on how they can maximize the profit, either by increasing the revenue or by cutting or controlling the costs. And in order to evaluate that, there are a number of different ways we can go about that evaluation. We can compare their actual income to budgeted. We can compare today's income to past periods' income to see if they're making improvements. Or we can compare with other like profit centers in the company, or even external benchmarked relevant competitors. And that's a relative evaluation. So those are the three classical ways to look at profit centers and evaluate their performance. Now, layered on top of profit centers, just as profit centers were layered on top of cost centers, we have something called investment centers. They're responsible for the costs, for the revenues, and also for the assets that need to be put in place to generate the profit. And the goal here is not simply to maximize the profit, as was the case with profit centers, but it's to maximize the return on investment, ROI. And the same types of benchmarks and evaluations can be applied. Here's a little quick quiz. You know, the investment center is really sum total of cost centers, profit centers, and then we put in the investment and assets. So really, investment center is responsible for all of these. Cost centers, again, when we think about evaluating them, this is where we shift back to the work we've been doing for the past several weeks, and that's the classic variance analysis. And we've become expert at that through our practice over the last few weeks. Profit centers, now we have to look at how are they doing in meeting their income targets, or how are they doing relative to budget. This is similar to the variance analysis we've been doing for profit centers, for cost centers, but it adds in the layer of revenue variance as well. We get to the third type of responsibility center, and that's the investment center. What we're looking here to evaluate them on is ROI, return on investment. It's the income that that investment center has produced divided by the capital base that it took to produce that income. So this makes us pay attention not just to income, but the level of investment that it takes to build that income. The ROI components, classical corporate finance equation here, we can break that down into the profit margin as well as the turnover on the invested capital. So the ROI is income divided by sales times sales over invested capital. It lets us pull that apart in a way to look at the two different parts here. We can look at income in a number of ways, but the most commonly accepted term is something called net operating profit after tax. And the tricky stuff here is we have to add back non-operating income. And then we have to adjust the tax benefits to make it a pure operating profit after tax. Here's an example here on this next slide. If we can zoom in here, we have net income of $3.9 million. But the interest expense that went into determining that income was $1 million. So we basically need to add that back in. In other words, we're no longer deducting interest expense. And also, we've got to allow for the tax savings that we got on that interest deduction. The result is a net operating profit after tax, strictly from operations, not from financing activities, of $4.55 million. Now we're going to use that number as we move forward here. When we calculate the invested capital, we also have to make some adjustments. And there are some common approaches that are used here. Total assets after we add back depreciation to reach the true asset base. Assets less current liabilities, and assets less non-interest-bearing current liabilities. So we have to choose the approach that is right for the company and the industry that we're dealing with. Here's an example again. If we look here, we see the book value of the assets, $70 million. But from that, we take away the value of non-interest-bearing current liabilities. What are those? Those are our payables, basically. Okay? So they're really not part of the invested capital base. They're just a part of doing our month-in and month-out cash flow management. So we get an invested capital here of $65 million. That's what we have to work with in the NOPAT calculation. The capital that supports the investment in our productive facilities. A little example here. Let's zoom in on Davenport Mills to get a look at how this works. Davenport had net income of $16 million, but as with the PowerPoint slide I showed earlier, they have interest expense included and a tax rate of 40%. So that gives us a clue of how we get, what we have to do to get net operating profit. Now, our assets total $225 million, of which $45 million are current, and $30 million of those are non-interest bearing. So let's see if we can do some calculations for this investment center, coming up with, first, NOPAT. And you can follow the slide here. We have to add back the interest expense and the tax benefit we got. So NOPAT turns into $16,780,000. Invested capital, total assets from which we subtract basically our accounts payable, and we get $195 million. So we've made our adjustments to net income and we've made our adjustments to total assets. The ROI slide shows we get NOPAT divided by our new invested capital for a return on investment of 8.605%. Play with that until you get comfortable with the adjustments there. Now, some of the problems we have here is, what is the right level of invested capital? Many times we're basing it on historical costs. Other problem with ROI is managers do not want to load up their investment. If you think of the way that equation works, managers become reluctant to invest in new equipment if they're going to be evaluated based on ROI. They want to keep the I low so the equation works to their advantage. To guard against incenting managers to not purchase equipment they need simply because it might drive their ROI down. Challenge. Now, we have this problem of overinvestment and underinvestment, and as we talked weeks ago, one of the key aspects of managerial accounting, one of the key principles is you get what you measure. If we're simply evaluating our divisions and our managers on profit, that can lead to overinvestment. If they have no incentive to keep the capital investment down, managers might do whatever it takes to increase profit. But on the other hand of that, when we're evaluating our divisions and our managers using ROI, that can lead to underinvestment in the way I spoke to on the previous slide. So what's the right happy medium? It depends. We just have to make sure we know what we're measuring and know what we will then expect our managers to do. Here's another little example. Let's change the cost of capital and see if we can come up with something called residual income. Now, residual income is how much the company is producing that exceeds the cost of the capital that they have to have in place. In this case, the residual income formula is NOPAT minus the cost of the capital times the capital we needed to have in place. In this case, the NOPAT from the previous example is $16.780 million. Our cost of capital is 10%. And we know it requires $195 million in operating capital to carry out our business. We see here that the residual income is a negative $2.7 million. What that means is our NOPAT is less than the cost of the assets that we have in place to produce that NOPAT. This is a company that is actually not adding economic value. They can't cover the cost of their capital base. So residual income is an important concept to keep in mind. The required profit that we're looking at is a profit that makes NOPAT minus residual profit positive. Okay? What we're trying to do is determine, is this a company or a division that can sustain itself? Can they, over the long term, produce operating profits that offset the cost of the capital needed to produce those profits? It's a concept you need to think about a bit. It's something that more and more companies are using rather than book income. Now we come to a concept called transfer pricing. When we have these multi-divisional companies with cost centers, profit centers, and investment centers, and if we have some of those responsibility centers doing business with one another, we have to decide what price we're going to use when we make these transfers of goods or services internally. What price do we set that values those internal transfers if we don't have to use external suppliers or don't have to go to external customers? Here's some classic alternative methods. We do these internal transfers at market price, or we transfer them at cost, or full cost, which includes fixed cost plus profit, or we somehow sit down and negotiate a price that's in the best interest of all the divisions and the company. What's the right answer here? Like a lot of other things in managerial accounting, it depends. What we want to do is come up with a transfer pricing scheme that leads these managers to make decisions that are in the best interest of the company overall. And we see that some conflicts arise when we're evaluating them on the performance of their own divisions. It's a real tricky and sensitive area, and we're going to explore that with some case analysis here this week as well. What we need to understand here is that there's really no arm's length transaction. We're not dealing with an external customer. So this is not even an issue for financial accounting. It's not an issue for disclosing to the external financial community. The way we arrive at the best decision is how can we measure the opportunity cost of producing an item and transferring it inside the company. Here's an example of what can happen if we lower the transfer price below the market price. We can zoom in on this little example here. If the transfer price is below market, we see the incentive shifts. If we're selling it at market price, we get a contribution margin for the company of $3 overall. If we transfer at a price below the market price, $5 versus $8, the incentives change. They change in such a way that the contribution margin to the company actually goes down from $3 to $2. I'd invite you to play with this and look at what's really happening here and what the incentives are for the syrup division and the candy division, and what kind of behavior that leads to. We're going to look at a company this week called Birch Paper Company in our case analysis that has a situation very similar to this syrup and candy company. Now, switching gears again, another way that we evaluate companies in a multi-division, evaluate divisions in a multi-division company is something called the balanced scorecard. You may have touched upon this in other classes. What we're trying to do here with the balanced scorecard is get beyond these measures like return on assets and residual income, or EVA. Because like financial measures in general, they're backward-looking. So this balanced scorecard moves us into the future and begins to look at measures around 4 different dimensions of performance. Financial, which is the outcome dimension. How well we're satisfying customers, measurement of that. How well our internal processes are functioning, a measure of that. And finally, are we continually revitalizing the company through learning and growth? And what can we measure that lets us know how we're doing there? The balanced scorecard can be mapped to our overall strategy, where we get levers of value creation in each of those 4 areas of the balanced scorecard that we can somehow tie to financial outcomes at the very highest level. The key here, again, is you get what you measure around the 4 dimensions of the balanced scorecard, hopefully all leading to something aligned with strategy. 4 dimensions, there are some quantitative measures and qualitative measures, and a balance of looking back to financials and forward to things like investing in growth. We'll see some ways that we can actually map this balanced scorecard to different strategy levers and make sure that we're keeping our eyes on the right levers and the right measures that are going to create future value. Here's a strategy map example. You see the 4 layers of the balanced scorecard. Financial outcomes on top, meaning we have to satisfy customers, meaning we have to have effective processes, meaning we have to continually be reinventing ourselves and learning and growing. All of that building to financial outcomes, but yet looking backwards down the causality thread here to make sure we're doing things today that will pay off tomorrow. In managerial accounting, we can construct measures at each layer of the strategy map, or representing each of the 4 dimensions of the balanced scorecard, and keep our eye on those measures. This is another area where managerial accounting goes beyond what financial accounting deals with in the external environment. The keys here are we've got targets that are easily understandable, initiatives that make sense, things that we can do to achieve the target, clear ownership, a commitment to fund the strategy actions, and truly top management support to pull this off. I would guess that some of you are probably working in a company that uses in some fashion a balanced scorecard. And it would be interesting in our discussions if we can share some of that. All right, thanks very much. This is a bit of a grab bag chapter where we talk about responsibility centers. We talk about the ways we measure responsibility centers, the ways we reward managers. Then we talk about the issue of transfer pricing and how we make sure the right incentives are being offered. And finally, we talk about ways to look at our corporate performance from a balanced way, historically as well as forward-looking. It's a lot to digest, but it sort of recaps a lot of the other concepts of managerial accounting and gives us a way to apply it in a strategic kind of a setting. Thanks.